Hello, everyone. Welcome to the Alliance for Regenerative Medicine's panel, ad hoc panel, I should say, on cell and gene therapy investment in a post-Silicon Valley Bank world. I'm delighted to be joined today by this great group of panelists to discuss this topic. I'd like to introduce Gbola Amusa, who's the partner and chief scientific officer at Chardan. Jen Audeh, who's the partner and co-chair of business development at Foley Hoag, a law firm that services a lot of the startup community. Andy Lewin and Keegan Ames, who join us from the BGR group, where they are part of the financial services practice. BGR is a public affairs firm in DC who has a deep connection to the healthcare industry. And then Ellie McGuire, a managing partner at Polaris Innovation Fund, a leading VC organization based in the Boston area. I'm Dave Lennon. I'm the CEO of Satellite Bio and the vice chair for the Alliance for Regenerative Medicine, who is sponsoring today's session. The Alliance of Regenerative Medicine, or ARM, represents the interests of over 400 member organizations looking to deliver innovative advanced therapies in the regenerative medicine space to make a difference in the lives of patients now and in the future. Our topic today is the fallout from the SVB bank situation. It's really shaken the biotech and tech communities. And our discussion today starts with a recap of what's happened overall, where we are now, and what we're going to do next. We have an amazing and diverse group of perspectives to bring you from this group and to address the problems that this situation creates and hopefully discuss some of the opportunities that this event might provide. I want to let you know that if you do have questions you'd like to ask this panel, please feel free to send those through the Q&A button on the webinar, and we will try to address those as we go through our discussion today. So let's get to it. I want to start with a little bit of what's happened. And I know we've all read and lived through a lot of this experience, but maybe starting, Andy, Keegan, with you, can you give us a quick recap? Why did SVB collapse?
Sure, and thank you, Dave, and thank you for having us today. I will try to keep this relatively concise because obviously we could talk about this for a while. And typically anytime you're talking about the banking industry and deposit insurance, it's not a good thing. So listen, it feels like the story has been going on now for months, even though it's barely been a week. If you back up to last week, you had obviously Silicon Valley Bank that had to go out in the market and sell what turned out to be about $21 billion worth of treasury notes. And they needed to do that because going back to last year, a number of clients of the bank had started withdrawing deposits. The public and private capital markets had slowed pretty considerably last year in a high interest rate environment. So Silicon Valley Bank had to go out into the market, sell bonds at a loss, which we can talk about later. The next day, they had to report that on their 8K filing to the SEC. It was a material event. They had to go out into the market and do a slightly over $2 billion capital raise to replenish some of their capital. This unfortunately happened at the same time that Silvergate Bank was closing last week. So in what may be the most unfortunately timed capital raise in the history of the banking industry, a lot of their large depositors, customers of SVB were really on guard. And a lot of them, of course, had portfolio companies that had money in Silvergate as well. So you sort of had this cascading effect. You had a number of large VC firms suggest to their, or maybe more than suggest to their portfolio companies that they pull money out of Silicon Valley Bank, and there was a flight to safety and a de-risking. And as we all know now, things snowballed very quickly. And within about a day, there were roughly $42 billion worth of deposits that were withdrawn. And that led to activity over the weekend and closing of the bank. Maybe I'll turn it over to Keegan for his perspective as well.
Yeah, appreciate it, Andy. And that kind of took us into Friday when the FDIC put SVB in receivership, and then really spent the weekend trying to find a solution before the markets open on Monday. That solution included a potential auction on Sunday afternoon, and not finding a suitable buyer or finding someone that could take on the portfolio the FDIC, the Federal Reserve, and the Treasury put SVB and another bank's signature into an SRE, a systemic risk exception, basically ensuring, and traditionally under the FDIC's regime, only insured deposits would be guaranteed, but through the SRE exception, they were able to insure all the uninsured deposits. So that had a calming effect. And the reason they did that was, one, they couldn't find again, as I mentioned, a potential buyer. But two, really had that calming effect to make sure that there wasn't a panic and a run on additional regional banks, to the extent that they could calm those fears going into the market opening on Monday. So we're now seeing, sort of at the end of that, it's, that all the SVB depositors are able to access their funds. I know others are going to talk about that experience, but we're now seeing sort of the aftershock around the rest of the industry with other regional banks, some of the European banks as well. So that's sort of the state of play as to where we are right now.
Super. Thanks for the summary. And we'll come to some of the events that are happening now in a few minutes. But I wanted to ask a couple, immediate consequence questions. And starting with Gbola, Chardan serves as an investment bank, serves a lot of the key equity players in the public side of the space in biotech. Our member organizations are part of the cell and gene group within that. And what happened to those equities in the immediate aftermath of SVB's collapse?
Yeah, thanks for having me, Dave. Actually, the stock started to move a day before the March 8 announcements, interestingly. You can imagine sometimes the financial world sees things coming. But since, let's say, the March 6 close until the low, the big indices, the Dow, S&P, NASDAQ, they were down about 5%. And biotech was down 5 to 8%, depending if you're looking at small cap to large cap. With a little bit of recovery, the broader indices are now down 1 to 4%, and biotech's down 3 to 6%. Again, if you're looking at large cap versus small cap.
Yeah, so overall down, but not a major crisis yet in the confidence in the sector.
The bigger crisis is what happened in 2020 and 2021. Where, believe it or not, the Dow and S&P were up 5% or so. NASDAQ, which is more long-term, was down 10%, and biotech was down 46% since the end of 2020. So small caps were hit even harder than that. So that's the bigger issue in the space is all the dilution if you do an equity raise these days.
Yeah, that's for sure. And it certainly feels like repeated trauma if you're a biotech CEO these days. Jen, I know you've been counseling clients this week, hopefully not as a therapist, but for legal advice. Who was most impacted in the community from this event, and what did you see happen over the last week?
Yeah, and thank you again for having me. And there was a lot of therapy going on, I think, as we were left without a lot to do. I would say everyone was impacted by this, from the smallest company to our biggest public company clients. SVB was the bank of choice for a lot of startups, a lot of people in the tech and life sciences industry. I'd usually be here talking to you about going out and how you get venture debt, and SVB is the biggest venture debt provider out there in this space. And so we had, a lot of clients impacted either because they had funds directly held at SVB for company operating accounts. They were funded by, venture capitalists whose funds were at SVB. They had customers and payables that were supposed to be coming in. So it ran the gamut of it touched everyone. And I think that's why it was so shocking. It wasn't just the small company. It wasn't just the big company. It wasn't just the, billionaire investors. It was everybody. So it was a real shock to the system.
Yeah, it was certainly, as an SVB customer, I felt that shock over the course of the weekend, and certainly breathed a sigh of relief on Sunday when we heard about the Fed's coverage of the bank. But there were a lot of crazy things going on over the weekend. What were some of the things that surprised you most once SVB started to collapse?
Yeah, I think it was, how fast it all happened. Like Andy was talking about, it sort of spiraled very quickly. And I think how quickly both the companies and their investors jumped on this issue, whether it was talking about whether they should pull the money. And that was the conversations people were having Thursday and early Friday morning. And then it was, what do we do at 11:52 on Friday? Everyone had to figure something else out. And I would say, not surprising, because I think this community is fantastic, but how quickly everyone came together. Investors were there trying to find a way to fund payroll, which was the biggest issue people were dealing with. Everyone was coming up with contingency plans, and it was all hands on deck to make sure, this industry made it to Monday.
Yeah, it was really great to see that. And I know we had, many folks reaching out to us about how they could offer help. Ellie, what, from your perspective on the investor side, what did it mean for you as a firm and for your portfolio companies?
Yeah, I mean, I think similar to a lot of what Jennifer said, we were looking at this from two different components. One is for those venture capital firms who have a lot of money themselves at SVB, right? Like what is our current situation and how do we report that to our limited partners, right? As well as kind of the risk within our portfolio as a whole and individual company status, right? So I think it was, again, one of these exercises of immediately reaching out, seeing what every individual portfolio company's status was, how much capital they had at SVB, what type of accounts that their money was held in. Was it on the balance sheet at SVB? Was it in sweep accounts that were held by a third party? And therefore, when we felt or could try to anticipate when capital would be available. And then exactly as Jennifer said, in the very immediate term, how do we manage payroll for these companies, right? So it doesn't kind of backlog and fall back on the CEO, who I guess is like technically liable to try to fill in that gap, which is obviously not the kind of, pressure we want our CEOs to feel. So it was kind of a flurry of different dynamics and information gathering and risk assessments, essentially.
Yeah. Yeah, for sure. And I know in Massachusetts and California, there are legal liabilities for a CEO when it comes to missing payroll. And that was certainly a consideration, I think, for a lot of folks in our space. It's interesting that the last week reminded me of the movie It's a Wonderful Life, right? Where Jimmy Stewart's trying to protect his bank from withdrawals. And I heard stories of, people going to the SVB branches and asking for 7-figure cashier checks. In some ways, it feels like, we created our own problem as an industry, tech and biotech together, in terms of withdrawing cash from SVB. I think Keegan mentioned or Andy mentioned $42 billion in 24 hours, right, was withdrawn from the bank. In many ways, we accelerated the downfall. I tossed this up question to anyone who has an idea, in many ways, it felt like initially every company for themselves. Is there any way we could have behaved better as an industry or as a group to, prevent this kind of activity? Anyone could jump in on this one.
I'll weigh in a little bit based on the conversations we were having with our clients. That was the first question on Thursday was, should we move our money? And as lawyers, we're not in a position to make that call. What we could advise on is, can you do it? And in those conversations, I'll tell you what I heard was a real reluctance from our clients to move their money. They didn't want to participate in a bank run. They saw what was happening and said, well, this can't be good. On the flip side, where they were coming from was, I have to protect my company. I worked so hard for that raise and I've got to protect it. And, to what Ellie was saying, I've got to protect myself, because if I can't make payroll, I've got liability, or I have to furlough my employees. So we saw a lot of, I think, real internal struggle from founders and companies they didn't want to do it, but they also didn't want to be the last one holding the bag and trying to make that determination. And at the end of the day, some people were just stuck. They actually couldn't even move the money because it had nowhere to go. So it was, I think, a real struggle for people.
Yeah, I think that's great perspective, Jennifer. It was really a catch-22 in a traditional sense of, not wanting to do the wrong thing here, but also recognizing that, you don't want to be left with that risk. Jennifer, if I can continue with you, as we are now, as the Fed has stepped in around SVB Bank and we're into this question of broader market impacts, what does the broader market fallout mean for biotech and cell and gene equities and private companies? And are there residual risks we need to be aware of at this point in time?
Yeah, I think this is what everyone's talking about this week now is what does it mean going forward? I think the market was already in a little bit of a tough place coming into the start of the year. Fundraising was getting harder. I think the risk that people are looking at is cash management. If you do get that fundraise, where does it go? Does it make sense to have it all in one deposit account? I think, investors are really poking at companies to understand payroll. I mean, everyone was talking about payroll. How much payroll do you have? Where is it? On the flip side is, and we'll talk about this when we get to the where we're going. I do think what's come out of it is there've been all these conversations about how valuable the SVB portfolio was, its spot in the innovation economy, and it's getting a lot of interest from other players who were not really there before or who were kind of dabbling. And so, yeah, I'm hopeful we might actually see a little bit more interest in investment in this space from bank players who are typically a little bit more conservative on making these types of loans to early stage companies, especially in life sciences. And because I think what everyone realized, it was not the venture debt portfolio that was the issue here, that had the most value. And that's been a huge topic of conversation. So I think that could lead to more investment on the debt side.
Yeah, that's really interesting. So Ellie, for your portfolio companies or venture-backed companies in general, what should we be doing today?
Yeah, I mean, I think a lot of people just had trust in the system, right? Which makes sense, right? SVB was super established bank and we used it for so many years. I think now we're recommending that everyone go back and take a really hard look in terms of what is the best way to secure your capital, right? So different things that we've heard and can play around with are, do you have capital at multiple banks? And try to, have some security in that way and diversification. Some are saying, you shouldn't really be in a regional bank, right? You should be in a large diversified bank with, diversified portfolios themselves. Again, in terms of how you manage your capital from what accounts, right? Like, don't just keep it in an operating account. They should be in sweep accounts and that are in government-backed securities, right? So all of these kinds of, holding more capital off balance sheet at those banks. So all of these are kind of like different themes that we're looking at and managing. I think one of the struggles too is that some of these regional banks are really easy to work with, right? They're very compatible to working with small companies and having an easier time doing bill pay and all of these different elements. And so that's something that we're saying kind of, okay, if you're going to be at a regional bank, then, try to keep your accounts at 250 or below so that you're FDIC insured, right? So it's just taking like a super thoughtful approach and for, audit committees to just be really aware and take a good look. Whereas I think previously, especially smaller companies that maybe don't have a full-time CFO, were just kind of like, our money is fine in an operating account in SVB. And I think now we're kind of like, that's not quite enough. We need to be thoughtful about this.
Yeah. It's an important, I think, wake-up call for a lot of folks about, how we manage what it's, usually a large sum of money in the raises that we have and how we protect that effectively. So all good points there. We did have one question come in through the Q&A. I do want to encourage folks to put questions into the Q&A and would love to, because we'd love to answer questions that may be on the line. And it's a good point maybe to go back to Gbola. Would love to for you to comment. Jennifer was talking about how valuable some of the SVB portfolio was. I think when you look at their ability to cover deposits, it actually was quite high once the Fed took over. And I think some of the comfort around some of the political fallout we can talk about later that generated. But could you comment on why you think a buyer hasn't been found for SVB assets and what that could look like going forward?
Yeah, I mean, with regards to SVB assets, I thought that some of the assets were in fact purchased by Goldman. And so I can't really comment beyond that. But perhaps I should, just follow up on what public companies could be doing or should be doing. So I mean, I want to put SVB in the context of we're in a 2-year biotech winter for financing, and the key issue for biotech companies that have to raise money every 18 months is basically cash and financing to get it. So I think there are a few things companies should do to insulate going forward if there is contagion. The first is they need to have very clear conversations with their investors to see if there's appetite to continue to fund the company, because a lot of companies are caught at the last moment not being able to raise money, and some have shut down, management's been kicked out, or they have to sell themselves. A second is to attract new money, they do have to understand the importance of catalysts. Investors need a return, so if you're a preclinical company without a catalyst, that's going to be a tricky situation when it comes time to finance. Third, and this is important for all companies, is to streamline to reduce cash burn. If your horizon is 1 year versus 3 years, the stock market behaves very differently for the same companies, for the same fundamental value. If cash is running out, it trades down due to liquidity issues and dilution. The fourth point I'd make is that consider getting rid of programs that are going to cost a lot to finance, so large market indications. Next one I'd make is that you should be careful about taking on debt, because some companies are starting to shut down. You see a company down dramatically today because they may not get a milestone, and that company therefore could be under more severe issues for that reason. And the last one is for companies that are considering going public. It's good to have audited financials, because then you can move quickly to the extent biotech markets do open up. You could do traditional IPO, you could do reverse, back IPO, and certainly a sale is always an option as well.
Thanks, Gbola. Quick question that came in online is, can you define what you mean by a catalyst?
Yeah, so investors put money into a stock in order to reap a reward later. So $100 in today hopefully becomes $130 or $300 later. But you need an event, some news flow, some data. So phase 1, phase 2, phase 3 data, and that changes the valuation of the company. So smaller cap investors sometimes need catalysts sooner. I used to say something's interesting in 2 years, but one legendary biotech investor said that's 3 jobs away from Gbola. You know, it's a little more short term for many investors.
Yeah, no, it's a great point. I do think we lived in a market for a long time where you could kind of ride the wave of continued valuation increase, and now it really is very much individual catalyst by individual catalyst for each of the companies that are out there, from much reduced baselines that we've generated over the last year of market decline and downturn. I wanted to switch over maybe to talk a little bit about how this has played out in with the government and in the public sphere, and come back to Andy and Keegan, talk a little bit about what did this look like to the outside world. We very much live it day to day, but how has this played in both with the government and with the public more broadly?
Yeah. Thank you, Dave. It's a good question. In many ways, we're seeing all this play out in real time. Members of Congress and their staffs are trying to figure this out in real time. And in the same way that we saw the FDIC, Fed, and Treasury act in real time and come up with some creative solutions over the weekend, you're seeing the same thing from Congress. You sort of have, I'll say both ends of the spectrum. You've got the far left that would like to just have a conversation about overturning the Dodd-Frank reg relief that was enacted 5 years ago. You have other folks on the right who just want to make this an issue about ESG and wokeism. So if you can sort of separate those out, and then you find the members who are closer to center right, center left, I think there are some interesting policy prescriptions that are being thrown out there right now, and I'm skeptical. And I'm skeptical that there will be a congressional solution, that there will be legislation enacted. Although there may be. Congress sometimes surprises people in a crisis. If you look at what's happened with crypto legislation, nothing really meaningful has happened and may not happen over the next 2 years. Depending on what happens in the markets, this could be a different situation. So you're seeing interesting pairings of bipartisan members. both parties getting together, sending letters to Michael Barr at the Fed, sending letters to Treasury. Secretary Yellen was up in the Senate Finance Committee testifying this morning. I know a lot of the focus here, and part of this conversation has been around deposit insurance. And I know Senator Romney and others have had an interesting idea about just providing universal deposit insurance, but charging an insurance premium for those with large uninsured accounts. So while you may not see, Dodd-Frank 2.0 pass, in fact, I think you won't, you may see something narrower that is much more targeted to the current moment. Then the bigger question that none of us have any answers to is, is Congress and are the regulators just fighting the last war and not looking ahead to what could be coming up next? But that's a problem for other folks to deal with at the moment. Turn over to Keegan quickly for his thoughts.
Yeah, I would just add, I think Andy captured the congressional side fairly well. I would just add, from the regulatory perspective, the minute that the FDIC took receivership of SVP, this was really like their issue to deal with. And I think to the earlier question, and this is just purely, what many in town are saying is, a lot of the larger banks, the too big to fail banks, probably weren't invited to the auction for SVP because of the appearance of, you don't want to give a large regional bank over and contribute to like a large bank taking that on. So, when you think about it, SVB is a $200 billion bank, or at the time was, closer to 100 billion. It's hard to find suitors in a 24-hour period that would be able to take that on. So there was really no other alternative but the SRE exception to restore kind of faith back into the consumer. So I think, to Andy's point, from both sides, I don't think there's been a lot of criticism right now, and we'll see, May 1st is when the Fed is going to come out with its report of how the supervisory and regulatory failings of SVB and what could have been done differently. But I think right now the conversation's about how do you restore faith back into the deposit insurance space, and, how do you avoid this happening again?
Yeah, it's a couple of interesting dynamics that come up, right? One is the fact that while these are non-guaranteed deposits, actually in the end they were guaranteed, and the government stepped in to do that, which has interesting implications for what does federally insured deposits really mean. I think the second thing you raised a little bit is the concept of buyers and who was really available to take this on. And I do think it was a question that we got from the audience. I do think there's still the opportunity that you may see buyers emerge for SVB Bank. I think for a lot of the big banks, the total deposits was small, and the service offerings they were having is complicating for their businesses. And so many ways they didn't jump in, but you may actually see more mid-sized players or other types of players try to get into this discussion. So maybe coming back to a little bit of a conversation of, given this context overall, where do we go from here? And I think I wanted to start out with, what's core to a lot of our members is, how does the venture capital market develop coming out of this event? Does it change at all? So Ellie, your perspective on, does, the status quo remain for VC financing? Are we going to see, changes in the VC world as we come out of this event?
Yeah, I mean, not to punt on the question, but I think it kind of remains to be seen a little bit in terms of like exactly what the ripple effect is, right, for other banks, et cetera. Also, what are the implications for our limited partners, right, will also make a big difference in terms of what happens kind of with the VC community. Mm-hmm. Generally, my personal perspective is I come back to something that Gbola would say, which is that, the biggest challenge that we've been dealing with is the market over 21 and 22, right? And so to me, that continues to be more guiding kind of the volatility and vulnerability as opposed to kind of the SVB situation as it stands. So I think, but we'll see in terms of kind of how contained this will be. But, certainly the SVB situation aside, we've been seeing, obviously over the past 10 years, VC dollars and investment has gone up, right, consistently with the exception of last year, right, which it went down. I think generally we're feeling positive, right? In terms of, checks continuing to be written, more work being done in the area, particularly for early stage, with obviously the kind of valuations evening out, et cetera, and the implications that are there. So personally, I continue to remain positive, but maybe that's more a sign of my personality than a professional indication.
So, I mean, that's great. I mean, I think if I pin you down a bit, I think what your view is saying, listen, we had these macroeconomic trends. This event for VCs may just be a blip in, what is hopefully an overall optimistic outlook for, recovery of investment in this space. Gbola, I wanted to maybe thinking about the equity side, what do you think the impact of this is on the public market recovery? And in particular, related to some of the ongoing events, do these dynamics keep biotech equity valuations depressed as a result? Was one of the questions that came up in our chat, from the audience also.
Yeah, I mean, I used to do global strategy at a big bank, and my bias is always try to oversimplify to a lead indicator that predicts most of what you're seeing. And in this case, it's inflation. I mean, people focus on the Fed, but in 21, when these biotech stocks started to crack around February, it was inflation picking up, not the Fed acting. And it took a long, long time before the Fed actually acted. And in the quant model I've built, there's a strong negative correlation between upticks in inflation and the performance of these small cap biotech names. And so remember, the XBI went from 150 to low 60s. And then as soon as inflation started to turn, we went from low 60s into low 90s before this pullback into the high 70s. XBI is more small cap biotech weighted. So if the Bureau of Labor Statistics is right and inflation continues to come down, the XBI should rebound. I won't say the number. Anyone can call me offline if they want. But we should see better days ahead by Q3, Q4. Now, can the Bureau of Labor Statistics predict new COVID variants, what happens in Ukraine, global supply chain shortages? Can they predict contagion if more banks fail? Those are the big questions. But if inflation does come down, the market should open back up, and the biotech names should bounce. And bouncing will limit the dilution if in fact they do offerings. But again, we're 2 years into it, and if something doesn't open soon, a lot of companies will run out of cash, so they need to think about scenarios before long. So my bias is that this is more of a blip than anything else. To support that a little bit, some investors, this isn't necessarily my view, are saying that if there's less pressure on the Fed to hike rates, that might actually help the smaller cap names as well.
That's helpful perspective, and I think important for us to reflect that it's not all just interest rates and banking, that there is the macroeconomic effects of inflation, and that is an important consideration for us in the biotech world. So thank you for that.
Well, one quick point to add, the reason that's important, inflation and interest rates affect discount rates in models. So biotech names are profitable in 5 years, 10 years. And if you're discounting the good years 5 to 10 times in a DCF, valuation goes down, while profitable companies today don't face that same issue.
That's a great point. It's a great point. Thanks for adding. Jennifer, we're looking at this new environment going forward and heading, potentially into more volatility as we look out. What are the types of planning we can do as executives that would help minimize risk and avoid kind of these future situations from your perspective?
Yeah, I mean, I think it is about, and planning is the key word. Really, thinking hard about the cash needs, where the funds need to go, how you're going to fund everything that you're working on, the projects you want to do, the next steps. And then I think, really understanding and being thoughtful about your partners, both investors and, your banks. What I will say, what I worry about a little bit now is SVB was sort of a known quantity for, venture debt specifically. There's a lot, like I said at the beginning, a lot of people now trying to get into this space because they see an opening. And you want to know who you're doing business with. There's, unsavory lenders out there who may be trying to get in, or, very well-behaving lenders, but don't understand the space. I think that's why everyone flocked to SVB. They understood the business. Similarly, knowing your investors when you're out raising money, are they going to be there in this crisis situation? Like I said, we saw people coming together to get funding to these companies. That was the majority. There were some few unfortunate where the investors said, no, we're not, figure something out. We're not there. So I think it's asking those questions. Obviously, there's a lot that goes into those decisions, but knowing who you're in business with, carefully thinking about, I think as Gbola said, taking on debt. I'm a debt lawyer, so I like debt, but it's, I'm always counseling the client that this is not equity. You've got to pay this back. And if you don't, you're done. So just being really careful about that going forward. And I think expecting tougher questions from your investors.
Yeah, that's great advice. One of the questions that came in from the audience is a sub question in this area of planning. And the question is there any serious discussion of companies considering storing funds in stablecoin environments? Or what other ideas that people have around this? And you don't have, Jen, you don't have to comment on this if you don't feel comfortable, but maybe I open it up to the rest of the audience to think about this question if you have any thoughts or comments on that.
I'm not an expert in the coin side of things. I will just caution that there are things you have to think about, and whether or not moving something to coin is considered an investment, or is it really counted towards working capital. That can get at a lot of different issues. One of them can be your qualification as QSBS stock. Super complicated, and a long way of saying I'm actually not hearing those conversations. Certainly in the media, though, people are talking about what this means for coin.
Great, thanks. Andy, Key, maybe I come back to you. There's a lot of things that could happen. You were describing the scenarios of how people are co-opting this event, so to speak, to put it onto their talking points, agendas. How do you think this politics plays out? What might we see come from the government or out of DC in general related to this event?
Yeah, I mean, it's really interesting. It'll be fascinating to me to see what the public reaction is to this. Will there be a backlash against VCs? Some people will paint this and are already painting this as a backdoor bailout of VCs. And so I'll be curious to see. I mean, this is not the financial crisis, right? I don't know that we will see an Occupy Wall Street Part 2, because that moment was a question about who the government was going to bail out. And there was the whole conversation around moral hazard. And, you had a lot of homeowners who are underwater on their mortgages who did not get directly bailed out, while the big money center banks did. So that, touched a lot of people. It provoked a lot of backlash. Right now, I'm sure that there are a lot of retail depositors who are a little nervous, but it's not really the same conversation that was happening, over a decade ago. So I'm curious to see that, because as we all know, members of Congress tend to react to public opinion, particularly members of the House who have to get out there and run for re-election every other year. And of course, we're in a presidential election cycle. So a lot of this will depend on how much worse it gets, versus how stable the environment remains. But,
yeah.
One of the things. Oh, sorry, Keegan. Go ahead.
No, Dave, go ahead.
Yeah, one of the things that is very active in the healthcare world right now with the government is considerations for kind of the further implementation of IRA, as well as direct price negotiations. And there's been some statements by the Biden administration, as well as some guidance coming out of CMS about how they might approach price negotiations. Do you see this interacting at all in those conversations, or are those really separate things at this point, you think?
I think they're separate things, but I'll qualify here that I'm not a healthcare guy, so I'll defer to smarter healthcare policy people than myself. Yeah. But I do think that'll be separate. I mean, some of our clients have asked us about the interaction between the current moment and the debt limit, which no one has talked about for the last week for obvious reasons, but will need to be increased probably by the end of July. So I also think if this current moment doesn't get much worse, then there may not be much interaction between this moment and that moment when the debt limit has to be increased. So yeah, again, a lot of it will depend on what happens in the markets. We all saw yesterday what happened with many of the European banks and what's happening right now in the markets with First Republic. So I think the story is unfortunately not over.
Yeah, that's fair. And that was one of the questions that came through for the group on, we very much focus this so far, Britt, on the US situation. Things are starting to play out in Europe. Do we see that as anything different? Are there any unique risks that, might exist in Europe that, aren't or might play out differently there? I'd open to any perspectives from the group.
I may just jump in there and say that I think by and large, and Gbola was kind of talking about this earlier, there's two issues. One is the run on deposits at SVB. The second is this broader issue across the global markets, which is, we're really in a high period of inflation, and you have a fixed income crunch on a lot of bank books right now. For example, 10-year treasuries are trading like penny stocks. I think many financial institutions have been warning the Fed and the central banks across the globe that this is a real issue coming in, particularly out of a pandemic. And I think now you're starting to see that a lot of those banks that were fragile or were on the cusp, particularly you're looking at some of the European banks this week, are really getting kind of crushed. And that they need that bridge of liquidity simply because, of where the economy is and where rates have been. So that is a separate issue, different than like SVB and specific to like the run and where depositors are. But it's a very real issue about the global economy right now.
No, it's a great point, and I do take the point that it is broader. It's not necessarily a healthcare or biotech specific issue. That could materialize in those banks on the other side of the ocean. This program is sponsored by the Alliance for Regenerative Medicine. It's a trade organization that represents 400 or so other organizations, and many of those being biotech startups and established biotech companies. What should organizations like ARM be doing to support stable financial practices in the future, do you think? What's the mandate that we should be taking on as a trade organization? I open the question, anyone who has thoughts on that.
Well, since financing risk is a big issue, I think it's good to educate the companies on various options, and there's no single option that's right for every company, but you have to pivot when times change. And so it's important to be educated and have dual, triple tracks to understand where your money is going to come from. The science is way harder than the financial stuff, but they should understand the financial stuff as well.
Great, thanks for that, Gbola. And I do think part of the for many folks, organizations like ARM have grown up maybe over the past decade, where times were quite and financing was quite readily available. The focus hasn't been there, and I think that now is a time for us to think through, how do we support member companies as in a tougher economic environment, and how do we provide the right, guidance and education, as you point out, to our member organizations. Great. Again, I want to remind you, if you have questions, please do use that Q&A button and submit those. We're happy to answer those. But maybe I'll go around the horn a little bit now to close out our conversation, and an opportunity to provide both the yin and yang of where we are today. And what I'd love to hear from each of the panelists is, what are your strongest arguments for the fact that we are, at an inflection that leads to brighter days ahead for biotech and cell and gene companies in particular? And what are some of your arguments that maybe we're still headed for tougher times as we go forward? So maybe I'll start off with you, Jen. Your thoughts on where this might head, where we might go.
Yeah, I think so. I'm optimistic. We're seeing a lot of dry powder in there from funds that want to invest I think the one good thing to come out of all of this was there was so much coverage in the media about early stage companies, about biotech, especially around the, in Boston in particular, where I am, in the innovation economy. And people were just talking about it at the kitchen table now because it was on the news, and understanding what these companies are working on. And these are, really important, scientific developments that people are working on. So I think there's just now a lot of interest and energy and excitement about the industry that's sort of gone further than it was before. And again, to build on what I was saying before, I think people are recognizing the value that was there in a bank that invested and was willing to take a risk on these early stage companies. And so I'm hopeful that will, move things along. And like I said, I think what we saw was this wonderful community coming together to make sure that everybody stuck it out. So for me, I think, I'm very hopeful for the days ahead, and we've just kind of got to get through this. I think someone called it the biotech winter. So hopefully we'll make it through the other side.
Yeah, we'll have to put on our coats. Ellie, you expressed some optimism earlier. Can I push you a little bit on, what do you look out for? What are the risks that we have to be careful about, as we think about what could happen in this space? What are you worried about?
Yeah, I mean, kind of like a lot of what we've been talking about, right, is like we are just in a challenging macroeconomic time, right? And so there are certainly lots of risks. I think what I'm seeing, and Jennifer said this too, is that VC firms have kind of like been through a period of, for the past like 1 or 2 years, many have kind of said like, look, we're putting our pens down, we're figuring out what the market dynamics are. But at the end of the day, like, our job is to deploy capital, right? And so I think a lot of people are now feeling a little bit more pressure to get back in the game and start like making investments to be able to return capital to their limited partners. So I think there is more of a motivation now that's kind of like stockpiled over time. I also think kind of at the end of the day, again, this is like my optimism talking, but these are like massive unmet needs, right? And there is the potential for super strong financial returns. So at the end of the day, I think like we kind of come back to that and look at these challenging times as opportunities, right? So I think there are challenges for companies now in terms of like valuations being low. There's not, like you were saying, Dave, like capital isn't just available everywhere, right? Like a lot of people who came in to be like tourist investors in biotech have pulled back out. So there's not so much competition around term sheets. So that, and investing, financing rounds are taking a lot longer to get off the ground. So there are all of these challenges, right, that we're hitting along the way, and saying, yes, like your budget needs to last you 2 years, even though you thought it was going to only be able to last you a year, right? So we're making these modifications, right, to handle the macroeconomic situation. But I do think that at the end of the day, these companies are still going to continue to be incredibly meaningful, both, from an impact perspective and financially. And so I always kind of look at that as kind of an opportunity, and saying like, look, there may even be deals for VC firms that we'll be able to get into more easily, or kind of what are the opportunities we can take advantage now that we wouldn't have had in kind of that huge boom that we just came out of from a couple of years ago. So again, I didn't completely answer your question, but again, I'm overall optimistic.
Yeah, no, that's great. Thanks, Ellie. Gbola, on the equity side, any difference of opinion or anything unique you think is potentially, reasons for optimism or arguments that we're still in for some tough times?
Yeah, I mean, I'll start with the tough times argument, and then why I think better days are ahead. But obviously, it's been 2 years. I keep repeating this, and companies are running on fumes when it comes to cash. So if there is an even more prolonged recovery than anticipated, it'll only become that much worse. If there's contagion from these 3 banks, then that could also potentiate a worsening of, let's say, sentiment that affects small cap stocks. But hopefully it's limited. I note that Silvergate and Signature, the top 2 crypto banks, SVB had unique exposures. When things change a lot, some certain players will drop out and banks will get hurt. And so hopefully it's limited and sentiment just doesn't drop broadly. I think if we have to look at negatives in cell and gene therapy, I think has changed over 2 years, because 2 years ago, we went through 2 periods. We had just gone through 2 periods where a tremendous amount of IPO activity occurred. And we had a lot of companies that went public 2 years before they ever dosed a patient. And they were basically only looking at animal data as the catalyst for investors. And I keep telling people in my 20 plus years in healthcare finance, I've never seen a public company report a negative mouse study. Preclinical data just doesn't cut it. You need clinical catalysts. And 2 years forward, so many of those cell and gene therapy companies that went public preclinically are now clinical companies that have catalysts. So I think that's an important theme. A second super important theme, the most important one, is that cell and gene therapy is going to become remarkably revenue generative for the first time. So one estimate is that we'll go from 4 billion in revenues for the space in 2021 to about 45 billion in 2026. And that's a consequence of drugs being approved. And I'll focus on gene therapy because it's easy to do. That's where I've spent a lot of my time. But we had Luxturna and Zolgensma in vivo vector gene therapy. And then for years, there were no approvals. And that's because so much money came into the space, and drugs don't get approved a year after money comes into the space. It takes years and years. And then last year, 3 more gene therapies were approved. So we went from 2 to 5 after Roctavian, Hemgenix, and Upstaza were approved. And then more importantly, Wall Street consensus is predicting 8 more approvals in the next 2 to 3 years. So we can go from 2 to 13 in a relatively short amount of time. And we've seen this phenomenon in antibody drug conjugates, bispecifics, 20 other spaces in biotech. Early successes, sentiment goes up, takes some time, sentiment comes down, and then finally we have, I won't call it a gold rush, but let's call it better days. And so we're going to see a lot of drugs drive revenues, and big caps are going to take notice when they beat. They'll have to reinvest. They'll buy smaller cap stocks. VCs, I think raised 23 billion last year. The peak was 26 billion. Some of them will be rewarded. They'll start to IPO again if inflation drops down. Once money gets a return, you reinvest it, and good science continues to move forward. So I think being revenue generative will spur a lot of good things that happen in the space. And for the weaker players, consolidate, sell to stronger players that have a better cash position. I was on a board where we had to do that, and that's a way to get a return.
Yeah, it's a great point. Well, one, you paint a beautiful picture, and I would take it. So that's great. And I do think it's an important point, though. Like, not everyone's going to win that game. And how do you think about the combination and appropriate positions that you have to weather that initial storm and get onto the S curve of the improvement in this market is important for all of us as cell and gene therapy players. Maybe Andy, I'll come to you for some final thoughts. I started with you a little bit on the situation. How do you think this plays out for the industry? Strongest arguments for and against good outcomes?
Well, I'm kind of curious to see, obviously, what happens with a second auction for SVB, and if SVB is not kept whole, I'm really curious to see sort of who steps up to provide a lot of the banking services for the industry and for VCs in general. There's a lot of talk now about concentration risk, and that is something I think the Fed and the regulators and Congress will be looking at very closely. Of the top 20 banks, I don't think there was another bank that was as concentrated in one industry as SVB. And obviously we saw what happened with that on the downside, but for the last 30 years, there's been real value in having all of that subject matter expertise and knowledge of the VC industry consolidated in one bank. So I'm personally curious to see sort of how the regulators deal with that going forward.
Yeah, it's a great point, and it will be. And as a customer of SVB, I'm interested to see who steps in to provide services that we became accustomed to. So it will be a good outlook. We're approaching the top of the hour. I want to thank the participants today for taking the time. Ellie, Jen, Gbola, Andy, Keegan. We lost your Andy. We lost your partner Keegan, but thank him also. It's been a great discussion overall. big thank you to the Alliance for Regenerative Medicine for sponsoring this panel and putting it together so quickly. If you do have questions for any of our panelists, do feel free to reach out to them afterwards. They're all happy to answer questions that anyone in the audience may have that we weren't able to get to today. But overall, big thank you to you guys. Thank you for taking the time to talk to us and share your perspectives. And I think we look forward to seeing where this goes next. And I know as a community, we'll make it through together. So thank you for that. Otherwise, panelists will call it a day, and thank everyone. Have a good banking and good financing ahead.
Thank you.
Thanks
Thanks,
for
Dave.
having me.
Bye.
Thank you.